Be fearful when others are greedy, and be greedy when others are fearful. This iconic phrase by Warren Buffett succinctly yet profoundly encapsulates one of the most important pillars for those aiming to invest successfully in the stock market. But what does it really mean in practice? How can one identify the ideal time to buy stocks? This question lingers in the minds of many investors, from beginners to seasoned professionals. The answer, surprisingly, doesn't lie in market forecasts or complex analyses, but in solid principles that stand the test of time. Considered one of the greatest investors of all time, he built his fortune by adhering to simple investment principles, primarily guided by discipline, patience, and a long-term mindset. He doesn't get swayed by alarming headlines or market euphoria. On the contrary, he closely observes collective behavior and seeks opportunities precisely when the majority is fleeing. But why is it so difficult to act this way? The answer lies in human psychology. During crises, fear dominates the market, and selling seems like the safest choice. Conversely, during periods of growth, greed and the fear of missing out drive many to buy stocks at inflated prices. Buffett understood that to succeed, one must swim against this emotional tide. Now imagine if you could turn these crises that scare so many investors into great opportunities. Imagine capitalizing on moments when solid companies are being traded at prices far below their true value. This is the secret he has applied for decades, and one you can start applying today. In this video, we will unravel his strategic thinking about the best time to buy stocks. You'll understand why crises are, in fact, great opportunities in disguise, how to identify companies worth investing in, and most importantly, how to develop the emotional discipline needed to act intelligently, even when everyone around you is panicking. If you've ever wondered how great investors manage to build wealth while others lose money, stay with me until the end of this content. I'll show you, with real examples and practical strategies, how you can start investing with the same winning mindset as Warren Buffett. Let's discover together how to turn fear into profit and patience into wealth. To understand the best time to buy stocks according to Buffett, it's essential to grasp his investment philosophy. He doesn't try to predict the market. He doesn't aim to time the top or bottom of stocks. Instead, he focuses on finding solid businesses with robust fundamentals that are being traded at prices below their true value. This concept is known as value investing, an approach he learned from his mentor, Benjamin Graham. Buffett has always emphasized the importance of understanding a company's intrinsic value. This value represents how much the company is truly worth, considering its future earnings, cash flow, assets, and growth potential. When the market, driven by fear or pessimism, prices a company far below this value, a buying opportunity arises. A classic example of this approach occurred during the financial crisis of 2008. While many investors rushed to sell their stocks out of fear of further losses, Warren saw a historic opportunity. He invested billions of dollars in companies like Goldman Sachs and General Electric, taking advantage of the extremely low prices. Over the following years, these investments generated significant returns, precisely because he bought when everyone else was afraid. Another fundamental aspect of his strategy is the long-term mindset. He often says, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This phrase reflects a commitment to enduring investments. Buffett doesn't buy stocks expecting quick profits. He invests in companies with solid business models, competent leadership, and durable competitive advantages, known as moats. These moats ensure that the company can maintain its market position and grow consistently over the years. A notable example is Coca-Cola. Warren began investing in the company in 1988 after the market devalued its shares due to temporary concerns. He recognized the strength of the brand, its global distribution network, and its growth potential. Decades later, Coca-Cola remains one of the largest holdings in his portfolio, generating robust dividends and capital appreciation. Buffett also warns about the dangers of speculation. Many investors attempt to predict short-term market movements by quickly buying and selling stocks. According to him, this behavior amounts to gambling. He believes that successful investing doesn't require extraordinary intelligence, but rather discipline and patience. The stock market is a device for transferring money from the impatient to the patient. This quote highlights how haste and the pursuit of quick gains lead many investors to make mistakes. Instead of trying to predict the market's next move, he recommends focusing on what truly matters, the quality of the company. Buffett is renowned for his ability to identify opportunities during crises. He believes the best time to buy stocks is when pessimism dominates the market. During the 2020 pandemic, for instance, the global market collapsed, and many solid companies saw their stocks drastically devalued. While he was more cautious during this specific period, he has always emphasized that crises generate unique opportunities. This behavior contrasts with most investors who, driven by fear, end up selling during downturns. Warren does the exact opposite. He views market drops as price sales. It's as if companies were on sale, offering their products at prices far below normal. Imagine walking into a luxury store and seeing a high-quality product being sold at a 50% discount. If you already desired that product and knew its value, you wouldn't think twice before seizing the opportunity. Warren Buffett applies this same logic to the stock market. In the 1960s, American Express faced a financial scandal known as the Salad Oil Scandal, which caused its stock to plummet. Many investors abandoned the company, believing it couldn't recover. However, Buffett analyzed the business and realized that consumer trust in the brand remained intact. He invested heavily in the company during this crisis. Over time, American Express not only overcame the crisis, but also became one of the leading companies in the financial sector. This investment generated significant profits for Warren, precisely because he bought when everyone else was fleeing. Now that we understand that he seeks solid companies and invests with a long-term focus, it's time to delve deeper into how he identifies opportunities and acts strategically during periods of uncertainty. The key to applying these concepts lies in patience, careful evaluation, and the ability to act boldly in times of crisis. Buffett is a strong advocate for patience as an indispensable virtue for investors. He asserts that the stock market doesn't reward speed or impulsiveness, but instead rewards those who know how to wait for the right moment. This means observing, analyzing, and only acting when a stock's price offers an adequate margin of safety. This approach became evident when Warren waited years before investing in Apple. Although the company was already a giant, he only began buying shares in 2016 when he understood that Apple was not just an electronics manufacturer, but a company with an extremely loyal customer base, an integrated product ecosystem, and a powerful brand. His patience and deep analysis allowed him to identify Apple as a long-term investment, which became one of Berkshire Hathaway's most profitable holdings. He doesn't look for opportunities every day. He compares the stock market to a baseball game with no strike count, where the investor can wait indefinitely for the perfect pitch. This analogy reinforces the idea that there's no rush to buy. What matters is buying right. Another essential pillar of Buffett's strategy is the evaluation of undervalued stocks. He seeks companies trading for less than they are truly worth. This doesn't mean buying stocks just because they're cheap, but because there's a disconnect between the market price and the company's real value. To identify these opportunities, Warren conducts an in-depth analysis of companies' fundamentals. He examines the cash flow, being the company's ability to consistently generate cash. The debts, being companies with controlled debt, are more resilient, The competitive advantage, which can be strong brands, unique products, or business models that are difficult to replicate. The competent management, where leaders think like owners and allocate capital efficiently. A clear example is his investment in Moody's, one of the leading credit rating agencies. Buffett realized that the company held a dominant market position, faced high demand for its services, and benefited from nearly insurmountable barriers to entry. Even during volatile periods, Moody's remained profitable, proving to be a solid investment. Warren has turned crises into great opportunities. He understands that the market operates like an emotional pendulum, swinging between euphoria and panic. When the pendulum swings toward fear, the best opportunities arise. During the 2008 financial crisis, Buffett wrote an article in the New York Times titled, "Buy American, I Am." At that moment of extreme fear, he was increasing his positions in American companies because he knew the country would recover. His long-term vision and courage to act when everyone else was selling resulted in significant returns. This strategy relies on the idea that, even in challenging times, well-managed and financially healthy companies not only survive, but emerge stronger after a crisis. Successful investing requires more than technical knowledge. It demands emotional discipline. Warren understands that the investor's greatest enemy is themselves. Emotions like fear and greed can lead to rash decisions. That's why he avoids following trends and doesn't let himself be influenced by the behavior of the majority. He recommends that investors treat stocks the same way they would treat businesses, with seriousness and a long-term vision. If you bought a bakery, you wouldn't sell it at the first sign of trouble in the sector. Similarly, when buying stocks, you should remain calm and trust the analysis you've conducted. He also advises against obsessing over daily stock prices. According to him, the market is like a madhouse where every day someone offers you different prices to buy or sell your business. It's up to you to decide whether those prices make sense or whether it's better to ignore them. In the 1970s, Buffett invested in the Washington Post during a period when the company was trading for less than the value of its assets. The media industry was facing challenges, and many investors were hesitant. However, he recognized the brand's value, the quality of its journalism, and its leadership position in the sector. He bought shares at a significant discount relative to the company's real value. Over time, this investment multiplied many times, demonstrating how patience and sound analysis can deliver extraordinary results. By applying these principles, you'll be on the right path to building a solid portfolio, prepared to withstand market fluctuations and thrive in the long term. Throughout this video, we've explored in depth how Warren identifies the best time to buy stocks. We've learned that the secret doesn't lie in predictions or magic formulas, but in solid principles. Assessing intrinsic value, maintaining a long-term mindset, avoiding speculation, and acting boldly during moments of crisis. He teaches us that true success in the financial market is not a sprint, but a marathon. He shows us that patience is a powerful ally and that the best opportunities arise when we have the discipline to act rationally while the world around us is dominated by fear. But how can you apply all this to your own financial life? The path to financial independence and investment success is not reserved only for great investors like Buffett. Anyone with discipline, patience, and learning can adopt this mindset and reap the rewards in the future. Start today. Analyze your decisions, educate yourself financially, and have the courage to act when everyone else is afraid. Remember, true wealth is built with time, patience, and intelligent decisions. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. See you in the next video.